Hey everyone, it's Kirk here again at Option Alpha. So in this video, I want to walk through everything you need to know about bull put spreads, go through everything 101 start to finish, setup, profit zones, risks, automation, and then go through a real trade example. So I did a similar video to this just the other week on Iron Condors. Put a link to all those right below here so you can check those out too. But it was really popular. A couple of people asked me to do it for put spreads as well. So I'm going to do that here today. So let's first go through the setup of what bull put spreads are. So bull put spreads, also known as short put spreads or put credit spreads, it's all the same terminology. They all mean the same thing. You might see them in different platforms just labeled differently, but essentially what you're doing is you're creating a spread trade, which means you're selling one option and buying another option. In this case, for a bullish put spread, you are taking a bullish position using put options. You're going to sell a put option and then buy a put option at a lower strike price with the same expiration. And so what this does is this opens the position for a net credit. That credit is the amount that you can keep. It's your full and total profit that you can keep if the position expires out of the money and you get the full premium, and you get paid all of that money after buying and selling the contract. So you can think about this bullish option strategy as a net selling strategy. And what you're doing is you're selling a put option, which collects a lot of premium. You're taking some of that premium and using that to buy yourself protection or buy yourself insurance or a little mini hedge by buying a put option at a lower strike price. And what this does is it overall reduces the risk of the position, makes the position a defined risk position, so it's easier to calculate kind of how much you can make, how much you can lose on the position, and it's just generally a small position for a lot of traders. So here's what it generally looks like. So this is an example we'll kind of use here before we get into more real examples. So this is a bull put spread. Again, we'll link to tons of resources right below this video if you want to explore this more. But somebody might do this where the stock is, say, trading up here at, say, $55. So the stock might be up here trading, and you think that the stock is going to go higher or at least not drop considerably. So this is the advantage of a bull put spread, is that if the stock is trading up here at 55 and you enter this strategy, essentially you've got a break even in this example of about $49. So this allows you to make money even if the stock drops in value. It can actually go down about $6 in value and you could still kind of make money, break even, etc. on the position. Whereas if you were just to buy the stock outright, not only is it going to be super, super expensive to buy the stock outright and capital intensive, but if the stock goes down immediately from your buy price, you're underwater right away. So with a bull put spread, you can kind of give yourself the same relative exposure. You're not going to have the same upside as a stock, but it's also not going to cost you an arm and a leg. And you can do these for much higher probabilities because you give the stock room to go down and still be right on the position overall. So in this example, what we're doing here is we're selling a 50 strike put option. That's that first strike put option. That's what gives us this part of the payoff diagram, kind of this part of the option payoff diagram where we're selling a put option. We're collecting a ton of premium to do this. And then what we also are going to do is we're going to go out to the 45 strike and we're going to buy a put option down here. Now this is where the payoff diagram kind of reshifts and becomes fixed max loss. So this is defined max loss. We know exactly how much we can lose on this position because we sold a contract and we bought a contract in the same expiration, just with different strikes. Now the value of doing this is that if you were just to sell the 50 strike put option and you were to do this what's called naked or undefined, then basically if the stock continues to move down, you have all this undefined risk that just continues to go down. So the stock basically burns to the ground. You're liable for the whole thing at, like the whole loss all the way to zero. So what people do is they limit that loss by buying a put option at a lower strike price. So they take a little bit of premium from up here, a little bit of premium from selling this option contract, and they go ahead and they buy an option contract at a lower strike. And what that does is it starts to limit the loss on the position. So this is a pretty typical setup that you would have where you would have, let's say, a 50 strike put option that you sold, and then you buy the 45. The difference between that width is $5. That's how wide the strikes are in this case. So that's how wide the risk is. And if you net collected, let's say on entry, $100 credit. So the difference between selling the 50 strike put, buying the 45 strike put, if that difference was $100 of credit of premium, that's your max profit. It also can help us calculate the max loss because we take the $5 width of the strikes and we subtract the $1 of premium, and that's where we get the $4 of risk, or the 400 kind of notional real dollars of risk that you see over here. So again, very easy to calculate. These things are super simple. Because of this, a lot of people use bull put spreads, or like to use bull put spreads, because of their simple nature and their simple setup. It's just easy to understand for people. So let's talk about profit zones and risks in this position. Obviously, we went through some of that with the payoff diagram above, but let's just kind of give it a different look. So here you have a stock chart. Like I said, just use some kind of basic numbers, if you will. But let's say that the stock is trading right now at about $55, which is up here. This would be kind of where your profit zone is. You can see the setup here where we are selling a put option at 50. That's our first strike that we're selling. And then we're buying a put option at 45 strike, which is below. So what happens is that this essentially becomes kind of our payoff ranges. Now, I like to think of it like this. That's why I do these charts like this, because I visually just in my mind think of it like this. But if the stock was to just stay up here and just continue to move up here or go higher, obviously we make max profit. So the stock is out of the money. It's not even close to our strike prices. We collected this premium. We did some option selling. The stock did what we wanted it to do, max profit. All the way, we go on to the next trade. If the stock starts to go down, it can go down to our 50 strike. And at that point, we start entering into kind of these variable profits, variable losses area. And essentially what this is that sloped area. So this is that area where you're kind of in between the strikes, so it matters where you land at expiration. But as you start to get under 50, you start kind of traversing this variable profit, variable loss area on the P&L diagram. So here from 50 to about 49, which is your break-even point, this is going to be variable profit. So you're still going to make money in this range. This is where if the stock actually dropped and went lower, you're wrong on your assumption for where the stock is going to go. You didn't guess correctly or didn't predict it correctly, but you still made money, which is actually kind of cool. If you're actually seeing the stock and it drops below 49, but it still stays above 45, well, you're kind of in that variable loss zone. So maybe you lose $50, $100, $200, but you don't lose your max amount of money, which is the 400. It's only if the stock drops considerably in this diagram that we have here, and it starts to really, really go down. So like you were way wrong on your position. Well, your position would stop losing money and you would basically reach max loss at the level of your long out of the money put option, which would be your 45 strike here. And in that case, what you have is you have your max loss. That's where you lose the $400 on this example. Now look, the stock can go all the way down. It can just keep going. And every single time, the maximum outlay that you have is the $400 at expiration, because you're covered. This position's in the money. So this position's in the money, but you're covered by this position that basically acts as a hedge for that position, okay? So that's essentially what you're looking at for different profit and loss zones. So again, as the stock is kind of trading, you can kind of think about it as kind of moving in and out of different zones as it goes, right? So that's what I kind of do. I kind of think about the stock moving in and out of different zones. All right, so let's talk about finding trades. It's usually the hardest part. So if you understand bull put spreads, you kind of get it at this point or get the basics. Now the concept or the hard part is usually how do I find trades? How do I build a trade? And potentially how do I even automate this process? So before we talk about finding trades, let's just really talk about an important concept that's a little bit easier to understand with bull put spreads, which is this concept of expected value. So I want to review this using an example because it is really important. I think it's super important because I don't think a lot of people actually look at it at all. I use it as part of all of my strategies. It's inside of my automations. I use expected value because if you don't use it, what are you basing your trades off of? You can base it off of everything, and I'm not saying you don't base it off of other things, but if you're not using something to assess the value of a position, then you're just guessing and you're just blindly going through it, right? So here's what expected value looks like. And it's basically just taking some probabilities and starting to apply those to the actual position that you're looking at. So in this case, we have our still same bull put spread, right? Our 50 strike, our 49 strike, and a break even at 45 strike, and our break even at 49. But let's just start to assess some probabilities. So let's say that the position that we're getting into, maybe it's a month out or 2 months out, it doesn't really matter. We can assess it. And we can say, okay, look, the probability that the stock stays above $50, so kind of goes to chance of max profit, stays above $50 where we have max profit. Let's say there's a 70% chance that that happens. And this might be not too different from maybe positions that you built before, or maybe positions that you're interested in building is you want to build positions with generally high probability of success. So you say, look, there's a 70% chance that I make money on this position, I reach my max profit. On the lower side, we can assess the probability of the stock going 45 or below. So we can say, look, there's maybe a 25% chance that we are at max loss. So we've got a 70% chance that we're at max profit, 25% chance we're at max loss. Now, if you don't actually do the calculation, some people just basically look at this number here as the North Star and they say, well, it's high probability, so therefore it must be a good trade, which is not true. So if we actually just calculate it out for these exact probabilities and these exact values, we're getting to an expected value, some sort of value for this position. So in this case, the expected value is that we're going to either make $100 with a 70% chance of it happening. So we do 70% times $100. We add that to our loss potential, which is $400, and there's a 25% chance that we lose $400. So if we start to break these down, we've got $70 minus $100. The actual expected value of this position, as I've built it out here with these probabilities, is actually negative $30. So if you were to enter this position over and over and over and over again, you would expect that you'd actually lose $30 on this position with these probabilities. But that's not the whole story, right? Because option trades are not strictly binary, full loss, full profit, right? We talked about this middle zone that you have with bull put spreads and with any spreads, where you actually have these partial profits and partial losses. And so what we need to do is we need to account for all of the outcomes between the strikes also, because it can land in between those strikes. It's not like it's going to jump 50 and then jump down to 45. I mean, obviously the stocks can gap, right? But there's a probability, a range where it actually lands in between those strikes. So what we need to do is we need to actually do a proper EV calculation. This is what we do on Option Alpha, is we actually calculate the expected value inside of these sloped areas, which is really different. We think it's a better way of doing it than just guessing at the maximums. But we actually calculate those expected values inside of these partial profit, partial loss zones all the way through positions as you're building them out. So now what we can do is we can actually redo our expected value formula and say, look, here we're going to calculate expected value. We still have a 70% chance that it goes, we make $100, still a 25% chance we lose $400. But let's say that we calculated out that the average partial profit, partial loss was actually a $32 partial profit, right? And I just threw something in there just to give you guys an example, but I wouldn't show you all the calculations because we do literally by every single penny inside of that range, right? And then add them up. But now you get this kind of more advanced EV calculation, which is $70 plus the partial profit, partial loss zone average plus the negative $100 expected maximum loss times 25%. And now you actually get a positive expected value trade. So this is actually the difference between just kind of doing it by scratch, by hand, if you're even looking at it, if you're even considering it for your trades, and actually using a tool that would actually kind of show you this inside of your platform. So let's start looking at a trade example so we can go through and kind of show you how you can build these out and then how you can see these expected values and probabilities as we go. Okay, so I'm in here inside of the screener inside of Option Alpha. I've just screened for ETFs really quick, and then I've screened for just a basic low level of liquidity. We don't want to trade things that are not super liquid, so we can do a screening of basically a level of 4 on our liquidity screener. And we can just take one of these positions. Let's just say we take DIA, for example, and we want to open up DIA. We see all the stats here, we see all the information, and we want to grab a new position in DIA. Now let's actually build out and just build it out from scratch. And this is actually, I think, what a lot of people do when they build out positions inside their broker platform. It may look different, but the same mechanics are in place. When you do this manually, is you're just kind of shooting in the dark, hoping that something works out. And I don't know, it may work out. So let's say we're going to do June 20th expiration. So these are the next monthly contracts. And we're just going to select a short put spread or a bull put spread in DIA. And now we have to select our short strike. So if we select something that's down below where the stock is trading, notice the stock right now is trading at 426 and change. So maybe we select the 420. So this is kind of out of the money here. And then what we do is we're going to go down here a little bit further from 420 and we're going to buy, let's say, the 415. Okay, so now we do that. So remember, this is what we're doing. We're creating a bull put spread. We're selling the 420, that option right there, that option that we sold, that 420, we take in a credit of about $430, but we're going to use some of that money to buy ourselves protection at a lower strike. So that's where you get that net credit differential that you see right here, which is the mid price, the net credit, and your maximum profit. So in this case, this is still fairly tight. Market's moving around, obviously, but we sold the 420 put option, and then we bought the 415 put option in DIA. That's where it gives us this payoff diagram here, and you can see we've got a nice wide partial profit, partial loss zone in here as well. Now we pre-calculate everything for you, so you can see your mid price or your credit, how many days you have until expiration. We calculate your exact break-even point, which is here, which is 418 and change, kind of moving around with the market. We calculate your maximum profit. That's the same as your credit that you're collecting here with a bull put spread. So you can't get any more on this position, but the trade-off for that is, of course, usually that you want to have a high probability of profit. Now, in this case, the maximum loss on this position that I just built out really quickly was 390. So it's very similar to the example that we had before. And we can actually see, in this case, the probability of profit. So this is the probability that the stock stays above our break-even price, which is 58%. Again, if you're looking at this just on that basis, you might think to yourself, hey, this is a good trade, high probability trade. You might do some mental math here and kind of try to figure out where the expected value is, but it's probably not as good as just letting a computer and system do this for you. And then you have your probability of max profit and your probability of max loss. And once we have all of these numbers here, so essentially all of these numbers, we can then calculate an expected value for this position. And you can see right now the expected value for this spread that we just kind of threw up here is negative $91. You should not do this trade. To me, I don't think you should do this trade. I wouldn't do this trade. This trade has a high probability of success. Great. Defined risk. Great. Awesome. Nice time until expiration. Gives the market time to move. However, this position does not price out to have a positive expected value. Now, this is not the end-all be-all. It doesn't mean it's going to be a winner or loser. You could have a winner on this position, but if you were to get into this position over and over and over and over again, you're not likely to make money on this position because the times that you're going to lose, you're going to overshadow all of the times that you're going to win. Now, the value of using Option Alpha here is that we can actually separate this out and start to move and manipulate these strikes here to see, hey, is there anything else that might work? So let's go down to the 415, 410 here. Did that improve it, right? Our max profit dropped, but our probability of profit increased. That didn't really help us for our expected value here. So again, if you're not checking this, at least go in here and kind of pre-screen your trades and check them in here just to see what the numbers and metrics are. Now, if you want to do something a little bit different, which is how I do it, this is the first way that most people do it, which is just to kind of go into your broker platform, wherever you trade, just kind of plug in some numbers, pick and choose your strategy. I don't like to do that. I like to use something called Trade Ideas. So if you're inside of Trade Ideas here, it basically pre-screens all of these types of positions for you. And then you go on a shopping experience where instead of you're picking the strikes, you're kind of surfacing from the pool of potential trades out there, the trades that kind of fit your criteria. So you could do something like this where you go into Trade Ideas, you have a credit, and then you say, okay, I only want bullish positions, and I want positions that have a probability of profit over 50% and an expected value of $5 or more. Just literally doing that, and I'll give you a link that you can run this yourself in below the video here. Doing that right now gives you a very targeted list of potential trade ideas that you can go through, right? And we can just sort of whittle and filter this down a little bit more. And this will change every single minute because we're recalculating this stuff every single minute. But from here, you have something you can start to work with. So now let's say, all right, maybe I only want to do ETFs, okay? So now you get only these positions that kind of come up that these are potential trade ideas. So here's one that just kind of popped up on the top here. So this one is IBIT, and this one is the June 20th contracts. Again, same, about a month out or so, 32 days. Now this one's a little bit different because this one right here, you have a maximum profit of $78, a maximum loss of $72. Again, we calculate your break-even point here for you. Stock's trading at about 59, 51. You get your probability of profit at about 52%. So that's right here at the break-even point. So it's about a half-half coin flip trade. You could think about it as essentially a coin flip trade. Half the time you're going to win, half the time you're going to lose. But if this trade, if you can fill this trade for a decent price right here, you actually have a positive expected value, because half of the time you win, you're winning 46. The other half of the time you're losing 74. That's a positive expected outcome if you do a good job managing your capital, right? So that's a far cry from the difference that we saw in DIA, which was highly negative, almost $100 negative. At least you're finding trades at this point that have a positive expected value. So let's see if we can find some other examples here. This list, again, just completely changed as we were going through it. So let's do this, and we'll do, let's say, TLT. TLT is actually finding some trades right now. So here, let's look at some of these in here. We'll do this one right here. This one right here, highly expected or high probability of profit, positive expected value, probably a little too far out for my liking, only because I don't necessarily always like to collect very, very small premiums and then have a bigger loss. But again, if you wanted to make a trade like this, you'd have almost a 90% probability of success, little bit of positive expected value in this trade. Again, it's probably a better trade than that DIA trade for sure. But for me, I don't necessarily like to collect such a small amount of premium relative to how much risk. So I'm going to add one more filter in here. So let's remove those filters, and then I'll do a very low level reward to risk filter here. So that will kind of keep some of the premiums and credits a little closer together so that I don't get into a situation where I get steamrolled by a position where I lose one time and then now I have to make 45 new, profitable positions to kind of find that position back. So this would be an example where you could kind of go through here and now say, all right, I'm going to go through this list now and try to find any potential trades. If you open up the symbols here, you can see all the different symbols that are basically filtering for these criteria right here. So you can see there's 31 trades in Tesla, 6 in Netflix. This is where you find, I think, potentially some better ideas. So let's filter by GLD here because I still like to trade ETFs. And so this one may be a little bit better for me because I do still like making trades that are generally high probability. This one's right at 50% probability. But if I win 50% of the time, I make 513. If I lose 50% of the time, then I lose 487. So I'm losing less. That's where you get that higher expected value for this potential setup. So again, these are the types of setups that you definitely want to start to look for and start to find these positive expected value trades and then kind of fit the probabilities around what you're looking for your particular environment. So I'll just refresh the screen, see if anything else came up here. So this one actually came up here. This one's a little bit further out in time, may give us a little bit more time for this thing to work out, but it literally is a 50-50 trade with a little bit of edge built in for positive expected value. Maybe if you're bullish on gold, then you could enter this trade and get into this thing. All right, so another way that you could actually do this is using bots to automate the entire process. So what I just showed you was using trade ideas to find positions that you then selected, and then you get into those positions and you use bots to manage the position through exit options. However, if you have a more complicated strategy or you want to do something different to get into positions, you could use a bot to do this. Here's an example. This is a RevNinja ETF bot, and this is basically looking at a list of ticker symbols, so a watch list of symbols that I have, which is mostly ETF symbols, looking for overbought, oversold positions. So in this case, it has an RSI scanner that's looking for overbought, oversold positions. And all it's doing inside the automation is looping through that list of symbols, checking to see if the symbol's RSI is overbought. If it's overbought, it'll open a short call spread. But in our case, for our example today, if the RSI is below the low RSI reading, that might suggest that we want to get into the position and open a bullish put spread. So in this case, we would tell it to open a short put spread trade idea. And inside of this, we just basically tell the bot exactly what type of position we want. We want a bot in a position in the same symbol that has that low RSI reading, 5 to 23 days. I don't care necessarily about the actual strikes because I want something that fits my criteria. So if it's different strikes at 35, a 33 delta, a 42 delta, I don't really care as long as it fits my criteria that I'll show you here below. And then you can see I'm presetting my exit options, which is an input to take profits at 40%. And then we have some entry criteria, which in this case, the way that it's set up is that it's just a checklist of things that you want the bot to check before it gets into the position. So does the bot have enough capital? Does it less than 5 positions, hasn't opened more than 2 positions today, has less than 1 position with this symbol, so basically don't open multiple positions in the symbol. VIX is really low, like all of these things you might normally check if you were trading. And then down here for the position itself, I also have some very simple checks like the alpha is greater than 5, expected value per contract is greater than 5, risk to reward ratio greater than 60%, probability of max profit greater than 50%, right? So these are all the things I'm checking. So that will ensure that the bot is constantly checking these before it gets a new position. It has to meet all of these criteria before it opens that position. And if it does, then it would simply open that position, grab a new position for us. And again, here in my bot inputs, I'm setting the high RSI value, the low RSI value, and I'm setting my exit options exactly how I want the bot to manage the position. So this is a little bit different, like I said, than doing the trade ideas version, because with trade ideas, you're finding the position, you select the position. If you use it inside of a bot, you can actually tell the bot to find a position that meets your criteria. And if it doesn't find that position, it'll just keep scanning until it does find a position, which could be later today, could be the next day, 2 days from now, but it's better than just randomly entering positions, right? And hoping that the positions work out. So using our DIA example from earlier, it'd be pretty bad if we just entered a position that was negative $90+ of expected value. It's not likely we're going to feel like we're getting ahead because we're not, even if we have a high probability trade. So that is one of the key differences, I think, for trading bull put spreads. All right, so I hope you guys really enjoyed today's walkthrough and 101 on bull put spreads. I know we covered a lot of ground here. I hope it was really helpful. If you have any questions, please let me know. We'll link to everything, all these types of resources, different bot templates, different resources inside of Option Alpha, videos, other videos we've done on bull put spreads right below this video. If you did enjoy this, please let me know. Add a comment, upvote, like, share with your friends, help spread the word about what we're trying to do here on Option Alpha. And until next time, happy trading.